Hey, everybody. Welcome to the NC Tweener Fund, powered by NC Idea pitch deck. This is being recorded on February 16th, 2026. I am Scott Wingo, and I'm joined by my co-GP, Robbie Allen. Let's jump into this. So we are the team, along with Becca Ross, that manages the Tweener Fund. We have some volunteers. Right now we have Shuping and a couple other folks that help us as well, that are non-full-time, but these are the full-time folks on the Tweener Fund. Quick note, the way the Tweener Fund works is our potential investors are what's called limited partners, are accredited only. So this is not a crowdfund thing where just anyone can do it. This is an SEC rule. We did not make up this rule, and the SEC governs what an accredited investor is. You can Google that. It's typically someone that has a net worth that exceeds $1 million and income well north of 300K. It's complicated rules. Go read it. Depends on if you're married and how you count your house and things of that nature that are too complicated to get into here. We're going to be talking about investing in early stage startup companies, which is inherently risky. There is risk to your principal for doing this. We strongly recommend that this be a small part of, if you're interested, make this a small part of your investment strategy because there is significant risk. We are also a new fund, so we started in 2022, and the way this works is it takes about 10 years to know how a fund is going to do, and we are only about 4 or 5 years into that 10-year period. So we've had, what we think are good results, but we won't know until we get further down the road. Also, at that point, we'll tell you past results are not an indication of future performance. I mentioned potential loss of capital, and you should only invest if you're a sophisticated investor and comfortable with the amount of risk involved in this type of situation. So we're going to talk a little bit about our backgrounds briefly, talk about the fund and how it came to be, what our strategy is, some of our other investors, so you kind of get a feel for who you would be working with or in your cohort, a lot of the frequently asked questions we get, and then how you sign up if you're so interested and we want to learn more information.
All right. So thanks, Scott. I started my career at Cisco. Actually, I joined as a junior out of college because this thing called the dot-com boom was happening, and they needed programmers. And so I moved out to California and lived there through the dot-com boom and bust. I'm from Burlington, North Carolina originally, so local roots. After being at Cisco for about 10 years, I started my first company called StatSheet, which was a sports analytics company, one of the early ones in that space. I did it mostly because I wanted to answer questions for myself on UNC basketball. And I figured once I got all the data, I could answer questions on any team. And so I built a business out of that. That morphed into what's now kind of considered one of the first commercial generative AI companies called Automated Insights, where we would take data, early on it was sports data, and turn it into content. We would generate recaps of games. We would generate fantasy football recaps. We would do all sorts of content out of sports data. And then eventually businesses would come to us and say, well, we have all this other data. Can you generate content with our data? And so that's what Automated Insights became. Eventually was acquired by Vista Equity Partners. I did mention along the way, I got my master's degree from MIT. And then after Automated Insights, I started working on my PhD in machine learning at UNC. That was going to be kind of my post AI retirement when I was approached by the head of research at Duke University to start a machine learning company. And that eventually became Infinia ML. This was one of the early deep learning startups. We started roughly around the same time that OpenAI and many of those companies were started. And we had a large team of PhD data scientists out of Duke. And really that was kind of trying to find where you could apply deep learning in business. And so we did that for a number of years until the pandemic. Coming out of the pandemic, I wanted to do something in the health space because I'd gotten into health and fitness. And so along with my co-founder, Dr. Jared Pellu, we started Bionic Health, which was a health optimization company. That was acquired in the summer of 2025. And then I started the Automated Consulting Group, which is a boutique AI consulting company where we help mid-market companies figure out an AI strategy and now increasingly doing more AI development work.
And I'm from South Carolina, so I'm not a native North Carolinian, but I've been here since '95 with a 2 year stint before then. So I feel like I'm native. What is that? 60 years in North Carolina time. Uh, Went to University of South Carolina undergrad for computer engineering, then came up to NC State for a master's and fell in love with the area. Um, Went and got a job at a startup in Connecticut. Loved doing startups, but not cold weather. Moved back here in '95 and have started 5 companies. They're Stingray Software, which was C++ components for Visual C++ developers. Started that, bootstrapped it, sold it in '98. Then took the proceeds from that and started Auction Rover, a auction search engine. We were acquired by the guys that invented paid search called GoTo.com, who then changed their name to Overture. And then we spun part of that out as ChannelAdvisor 2001, raised 90 million in venture capital, went public 2013, and then that was acquired by private equity in 22 and rebranded Rhythm. I'm not responsible for that crazy brand, and I was no longer involved in that since 2022. I was CEO, founder from inception to 2015, and then on the board, exec chairman until 22. Then started Spiffy on-demand car care, and for about 10 years, from 2015 to 2024. And yep. And then started Refi Buy to do agentic commerce. So helping people buy and shop on, sell actually on, ChatGPT and any of the agentic, any of the Gen AI sites. And what I'll highlight with our background here is we're both operators and founders first. So this will come up later when potential investors ask, why do founders want to work with you? Between our careers, you can see here we've got 10 companies each that we've started and operated for long periods of time. We haven't seen everything, but we've seen pretty darn near most things you're going to see. So I've done acquisitions, I've been bought, I've been sold, I've done an IPO. Robbie's done many of the same things. While I don't code, Robbie still codes. I do more marketing. So we have a really nice balance between us of we can answer almost any kind of horizontal or vertical question. Also, Robbie does a lot of healthcare kind of stuff, and I do more commerce. So we have a really nice diverse background that gives us really good coverage for our founders here in the Triangle, and is one of the big benefits of why founders want to work with us. And just why we enjoy it. We would not be as successful as we are if it weren't for all the things and previous founders that have helped us going on. So our mission here, it's really a passion project. Trust me, we're not in this for the money. If we are, we're doing a terrible job at it. And we're in this to really up the Triangle's startup game. There's been some structural changes here that are good in some ways, but they have unintended consequences in others, and we're here to solve those things. So let me walk you through the timeline of how we came to be to give you a little history. I was between that company, ChannelAdvisor, and Spiffy, and I had some time on my hand. Whenever you reset and start a new company, and Robbie, I don't know if you share this experience. It's kind of like you're used to operating up here, and then you reset to zero, and you can only push the needle, the noodle up the hill so far in those early days. You just got to kind of wait for the gas to kick in, if you will, and you have some extra cycles on your hands. So that was a time where I had some extra cycles, and I realized I really like help mentoring folks, other founders that are a little further along. So kind of past product market fit, because when you try to help them before product market fit, it's a lot of, build something, get it to a customer, see what they say, and then iterate, and and you have to live it. That's why accelerators work really well there. And I just don't think there's another mechanism, and I really don't want to do an accelerator. Maybe someday we will have the resources to do one. I think we could use one in North Carolina. It's just not something that I have the patience for or resources at this moment. But what I also identified was we didn't know who our middle bucket was, so we had all these startups, and then we knew that we had some that were going to be really big, like Pendo. Even at that moment, everyone kind of knew, and that would be big. But we didn't know who our middle was. And if you've ever done sales, you need a funnel, right? And we basically had a 2-stage funnel. We had startup and success. We didn't have something in the middle like up and coming or Goldilocks. So I thought, well, I can define that. And I borrowed it from at this moment in time, I had a 12-year-old, and if for those of you with kids, that tweener phase is kind of hilarious these days. They think they're like 30, but then at the same time they'll do something kind of adorably kind of dumb and like run into a wall or something, or do something kind of crazy. So that's how a lot of these startups are. They'll get to product market fit, and where they're getting some uptake and some revenue, and then they'll suddenly be like, well, I'm going to go international and do 10 other products and things of that nature. So it's a good time for us to get involved, because we can give them that extra boost to get through to that graduate level. I did a bunch of analysis. I'm happy to talk about it in more detail. And I discovered that here in the triangle that there's a big separation point between companies that get to 10 people or 1 million and those that don't. So I thought that was a good break point for us to define this. So that's the entry point for tweeners, is you've got $1 million run rate, and that means $80K a month in recurring revenue. Then we have to graduate you at some point, and we basically choose 80 million a year in revenue or 500 people, whichever comes first. So started that in 2015, and then based on a bunch of data that we accumulated over time every year. So you can see in 2015 when I started, there was 48 tweeners, and now we have well over 300. And over time, people would say, well, it'd be cool if you tracked the number of exits and how much money was raised and the growth rates of everything and how many of these are closing and that kind of thing. And what I noticed in doing this, kind of around 2021, it got to be kind of obvious. You can see that investment line there. I noticed a couple things. I noticed, number one, traditional VCs will say, all right, we're going to invest in 15 companies over 5 or 10 years, and a third of those are going to be zeros. A third will be singles, meaning we may get back what we put in, and then a third will be our heroes, or they'll return the fund. This is used. These companies are on a power law distribution, which is kind of like Pareto's law amplified or on steroids. So the old 80-20 rule becomes the 95-5. So 5% of your companies deliver 95% of your returns, because occasionally there's companies that just really knock it out of the park and deliver north of 10x of what you put in, and then that comes in and covers any of the other things. That's the traditional fund. But I noticed, I have stumbled on a pretty simple algorithm here, and a mechanism for finding these companies. There's a whole lot of infrastructure that underlying this, but this is the basic thing. And I was like, what if we think about that as an index, kind of like the S&P 500? It has a lot of things that are beneficial. It has built-in diversification. It also, if you look at that closure percentage there, even over an arc of time, it's pretty low. So once companies in our region get to 1 million ARR, they stick around, and their chance of failure goes way, way down versus pre-tweener. And then because of this algorithm being trying to catch every company that has had a big exit in the triangle, minus biotechs, we have found very early on with this algorithm. So you catch 100% of the power law companies, and you also get a lot of the companies that have decent returns as well. So, and I also realized that I'm an LP in a bunch of local funds, and they're not in all the big exits. So a lot of times those get cherry picked by funds from outside the area with no local money in them. That kind of makes me frustrated. And you talk to the founders, and they just basically say, well, what was I supposed to do? I got better terms, and I'm doing the economically fiduciary responsibility for me and my company. I would love North Carolina money if it would just come in at the same terms. So those were the signals that we saw that said we need to do something here. Also, as our local funds have gotten bigger, they don't write super small checks anymore. Like in this pre-seed and seed stage, they're writing like seed plus or A checks. So started the Tweener Fund in 2022, and a lot of fun stories there. But we use a platform called AngelList, and when I talked to them, they said the average fund starts at 200K. We started a quarter, and we started with like 600K a quarter. So it exceeded expectations by 3x. This is a very popular thing with other founders in the area, people in the ecosystem, and people that want that really think this is an interesting area to add to their diversification strategy and their investment strategy. I started it solo, and then I realized I needed help within like 60 days, and picked up the bat phone and called Robbie, and he thank goodness came and it's been a huge help and helped me build this thing. Every year we always evaluate things and say, what more can we do? And we're what's called a 1%, 20% fund. So our management fee is very low. Usually it's 2% ish or 2.5, and we're at 1. So we have a very low management fee, and that's because this is a passion project. And those dollars go towards supporting founders. Examples of that are in 2024, we launched 3 pieces of content. We launched a long form newsletter called Tweener Times. And then we now have Tweener Talks, which is our podcast, very popular. And then we launched a community hub called Tweener Hub. Then last year in 2025, we launched a annual March Madness inspired bracket like startup pitch competition called Tweener Madness that will be back this year. Stay tuned. And then we're really excited because as we're recording this in 2026, we have just announced that we have been partnered with NC Idea, and we are changing our scope and our brand to be North Carolina Tweener Fund, powered by NC Idea. So NC Idea is a nonprofit that has been around for a very long time. They issue grants. They were actually one of the grants in Robbie's company. What was that, Robbie? 2007 or something like that? Yeah, 2009. Yeah, so Robbie is a good example of someone that has had impact from what they do with their grants. So that's the history of the fund, and we'll walk you through some more of the stats there. But you can see that we have a whole ecosystem we're building from the fund, and it includes a lot of founder support and content.
Yeah. So when Scott started this in 2022, and really it was around the idea of this index approach. And I thought it was brilliant because I'd invested in a bunch of startups. I had seen a number of startups. And to me, it's very difficult to pick the winners in the earliest stage, especially that sort of before they get to tweener stage. It's very difficult. And the analogy I always like to use is the private versus public markets. And so in the public markets where you have near perfect information about companies, they have these quarterly filings, they have all this information they have to disclose. The conventional wisdom is you still can't beat the index. That over the long term, an individual has not been able to beat, even the S&P over a period of time. And again, that's an environment where they have all the information, all the technology, all the available resources, and people still can't beat the index. Now, if you think about the private markets, we have not a lot of information about companies. There's not much of a track record. And so the idea that people can walk around and make judgment calls about which ones are the best, I just didn't believe. And so when Scott talked about having an index fund, especially with some specific criteria around it, and initially it was we're only going to invest in companies in the triangle. So our geographic focus for the first 4 years was the triangle. And so you had to be in that area. And then you had to be a tweener. Again, we also invest in companies a little bit before that, in some cases, again, with certain criteria. But the focus were these companies that were tweeners, which there was at least some information. There was some track record where they've gotten to $1 million in revenue. So they're not just an idea that's going to go away. And so when he started that, it made a ton of sense to me. And that's why I wanted to get involved. We already talked about the power law dynamics and the index-based approach. The early stage focus is, given the size of our fund, we're not going to be able to lead large rounds. We're not going to be able to do large late rounds. And so early stage made a lot of sense. Typically 70% of our investments go to tweener size companies. So that's companies above $1 million in revenue or 10 or more employees. We have historically done, 30% ish in companies that we call pre-tweeners. And these are companies that either have a repeat entrepreneur that we really believe in, or they're in an industry that Scott and I know really well. We have on occasion, done those. And especially with AI growing the way it is right now, that's probably going to become a more important part just as we, start to leverage some of these new AI companies that are coming about. The next piece is the geographic focus. Again, for the first 4 years, it was just the triangle. But now, thanks to NC Idea, we're able to expand to cover the entire state of North Carolina. And so this is super exciting because, we would get a lot of companies coming to us over the years that were maybe in Wilmington or Asheville or Charlotte or in the Triad, even in Burlington, where I'm from, and we couldn't invest in those because, again, we had sort of a specific charter around the triangle. Now, with the resources that NC Ideas bring into the table, we're going to cover the entire state, and so we feel great about our ability to do that. Now that we've done this for 4 years, we kind of know what the process looks like. We feel really good about being able to cover all of the state, and eventually have the North Carolina Tweener Fund represent not just the 165 companies we've invested in the triangle so far, but hundreds of companies across the state. The last piece that Scott's always been big on, and I've really enjoyed, is we're trying to create a virtuous cycle where, in part, we've created a really low entry point to invest in the fund. So it's $7,500 a quarter for 4 quarters. That's the minimum to be an LP in the Tweener Fund. So it's essentially a $30,000 commitment to be an LP. If you look at any of the other traditional funds in North Carolina, your minimum check size to get in is anywhere from $250,000 to $500,000 spread over a number of years, and that's a very big commitment. And we wanted to create something that would encourage entrepreneurs to also invest, because what we wanted to do was to get those entrepreneurs that are maybe later stage building their companies, had the ability to invest that $30,000, then they go on to have big exits, and then reincorporate some of those resources back into the Tweener Fund moving forward, so that it can be this virtuous cycle where we support early on entrepreneurs, they get successful, and then they can come back in and support the Tweener Fund, down the road.
Thanks, Robbie. A couple details on some of those aspects. So it's important as a potential investor to understand how this works. So the number one question I get is, okay, I like this, but how and when do I make money? So this is not like the stock market or a mutual fund where you can just dip in and out and remove your money. So you're making a commitment when you invest that your capital will be illiquid for a period up to 12 years. And hopefully it's shorter than that, but you just never know with these economic cycles what's going to happen there. And so that's number one. The good thing about that, though, is what's happening, hopefully, is your value is compounding inside of there. So you're not taking tax out; it's tax-free compounding. And then there's 2 ways we make money. So there's 3 outcomes for venture-backed startups. Number one is what we would call a closure. They don't make it, which is relatively common, and hopefully we've mitigated that. We will never mitigate it to zero. By going up market, the data indicates we've mitigated that. But it also is based on economic cycles. For example, COVID caused a lot of businesses to face a lot more uncertainty, and that was a stressful period for them. Then the other 2 outcomes are, and the most likely is you're acquired, and that's called mergers and acquisitions, or we call it M&A. And I would say 98% of the companies in our area get liquid through that type of a mechanism. IPOs do happen, initial public offerings. They're a little bit rarer, especially these days. When I took ChannelVisor public, the minimum revenue you had to have was you had to have line of sight to 100 million, 120 million as a SaaS business. If you look at Pendo here is, I think, well north of 200 million, and people keep telling them, well, you need like a little bit more to get there. So I think the number is 300. That takes a very long time to build a company that has 300 million in revenue. So they're becoming exceedingly rare, and M&A is the most likely way. And just to give you a simple thing is if we invest, let's say over the life of our involvement with the company, $200,000, and then we own a percentage, and they're acquired for 200 million, and we invested at 10 million, we should get 20x of our investment there in this one. So our 200K can become 4 million. That would pay back that one investment would pay back that one fund very materially. So that's how we do it. And by mitigating that risk in every little quarter that we do, by making 10 to 15 investments, it increases our chances of hitting a power company, and it also decreases our risk of concentration. So that's why we really like this model. And and how we focus on that. The other thing to know, and this is what really gets a lot of the other kind of angel groups, is your best returns are the ones that come last, and then your worst come first. So you're an LP, you join. Whether it's our group or something else, you put your money in, you're excited, and then in 2 years you start getting failures, and it just feels terrible. You're like, oh man, this is awful. Uh, but then you start getting a couple singles, and you're like, okay, this is good. And then finally, after 10 years, and many people stop after that first wave of failures, and then you get your big returns, and you're like, oh, I should have kept investing along the way because now I have this big gap in when I could get that type of return. So that's called the J curve. It's very common. One thing we do is we can go a little bit later occasionally. So we will invest in a Series A or B. And those maybe have a 5 year. We've been very fortunate with our fund. We've had like 5 to 8 different exits that have been pretty good, and so that has been a really nice way to help folks mitigate this a little bit. But it's still definitely a very common thing in venture investing. Where did my slide mover go? Here it goes. We're also this thing called a rolling fund, and it's almost like a subscription. So you subscribe for a year. The minimum commitment is 1 year, and it's $30,000 paid quarterly or $7,500. And I'll talk about that in a second. There's other ways to do these. There's syndicates, closed funds. We're in the rolling fund. This is administered by AngelList, which is how Robbie and I are able to focus so much of our time on the founder side. Many of these funds are just eaten up with admin fees and administrative tasks. All that is done by a back office that is paid for in the fee structure. And also it gives us committed capital. So we don't have to go to a group and make a committee decision every time we want to do something. We can go fast, which is very pro entrepreneur. Some of our best deals we get in have like a 4-day window of expiration. It's like, okay, I've got a little room in my round. I can squeeze you guys in. Can you do something in 4 days? If we had a committee that met every month or something like that, we would actually miss many of the best opportunities, I feel. We're also able to promote this fund because it's called a 506c. So Robbie and I can, just like this, we can put a pitch out in public. We can go on social media and talk about it, and within certain rules there. The fee structure. So we mentioned this before, but let me reiterate it. 1 year commit, 30,000 minimum, 7,500 a quarter. These quarters are what I would call in comp sci language orthogonal. You know when they're going to be. One of the things that's frustrating about traditional funds is they'll be out there at some point in the future, and then they always hit at the worst time, like when you're about to pay a big mortgage off, or you've got a kid going to college, or something like that. The way our fee structure works is a 1 and 20. So we make a 1% management fee. So if you put in of your 30,000, we make basically 1% of that over the next 10 years where we're running this for you. That is collected up front. And then AngelList has a 0.2% fee and then a minimum that is spread across all the LPs. Okay. Another benefit of being an LP is we do have 4 quarterly LP meetings. These are done through Zoom, where we walk through the portfolio for that quarter, what's going on in the market that we see, and then what's going on in the past performance of the life of the fund. And we don't go company by company because we're invested in so many, but we have them in various cohorts that we walk through. We also have 4 in-person events every year. Probably our most popular is one of our LPs is at Ruckus Pizza, and we just go out there and they have a beautiful porch we hang out on one afternoon, and it's about half LPs and half founders, and it's just a great way to meet people in the ecosystem you may not have met, and it's kind of central in the Morrisville area.
One thing we hear a lot, Scott, too, is that for people that want to get more involved in the startup community in North Carolina, we'll meet those folks, and the Tweener Fund actually is a good way to do that, as well as it not being a super high bar from an investment perspective. You essentially get a front row seat every quarter to us talking about all the companies that we've seen, and we tend to see virtually every company that's raising. And we can talk about them, talk about which ones we invested in, and so people that are wanting to be knowledgeable and understand kind of what the startup ecosystem's looking like in North Carolina, the Tweener Fund's a good way to do that.
Yeah, and we're going to, as we record this, we're fresh off of our geographic expansion, but we're going to be covering the state. So Robbie and I will be going either out west or east, north and south, and hosting a series of meetups as well. So we're going to expand this. No guarantees of how many. We're still navigating that, but it will definitely be more than 4 events across the state. And then also being partnered with NC Idea, they do quite a lot of events that we will ride along with as well. There's been a lot of analysis on this, and if you're interested in the math of this, I'm happy to share more information. On the left is a analysis done by Carta, where they basically kind of compared the outcome of high conviction portfolios, and that's the curve on the left, and then the curve on the right. And basically, what they're doing is they're saying what previously was called kind of negatively spray and pray actually does better than concentrated funds most of the time, unless one of those concentrated funds is lucky enough to get a Facebook or a Google or something like that. Those are once in a lifetime type things that don't come along very often, and that's why the distribution curve for index funds in the simulated outcomes and looking at what the data Carta has indicates a higher return on invested capital for this model. AngelList has a lot of data around what's the right number. If you're with us 1 year, you get about probably 40 to 60 in this zone. Ideally, I think you should stay around for 2 years, but it's up to you, and we're happy to share these papers around how this works. Who are our investors? They've kind of come in waves. When we first started the fund, a lot of it was fellow entrepreneurs. So you see a lot of successful entrepreneurs on here, like Mike Dornberg, Ben, Anil, but what we've seen is a lot of folks then it was folks in the ecosystem. So some of the lawyers in town, a lot of the sponsors that are out there that support our ecosystem. And now we're seeing folks that are just really looking at this as an asset class and saying, hey, I realize that, there's because there aren't many companies going public, the individual investor doesn't get a lot of exposure to modern technology. Like you can't really, other than NVIDIA, you can't invest in an AI company today, for example. And it's unclear if that's going to change or not. And so this gives you access to a different type of profile. A different set of alpha is what a sophisticated investor would call it. Again, high risk and all that, but if your investment strategy, you want to put a little bit of money in a high risk area that could have outsized returns or not, then that is what our LPs look like.
So with this, since the life of the fund, again, that's Q1 of 2022, this shows the blue bar is the number of investments per quarter, and the orange line is the amount of money invested per quarter. What we see is that there's some patterns that kind of arise year over year. Q4 tends to be, a little bit softer than some of the other quarters. But generally, we've been in the zone of 10 to 15 investments per quarter for the life of the fund. And then now with the NC Idea partnership, I expect that to go up a little bit. As we start to bring on more companies outside of the triangle, especially over the next couple of years, we'll be in this place where we're adding on quite a few more companies outside of the triangle, and so that likely will push these numbers up a decent amount.
Yep. And then this is kind of a cumulative chart, which by design is up and to the right. But we're really proud of this. And I would have never guessed, I probably would have guessed if you'd asked me in 2022, we'd be at maybe 5 or 6 million invested by now. So we effectively doubled that. And it's because of the massive support of folks like you that say, this is something I can get behind. It's got a financial piece, which is my number one priority, but it also has a slightly altruistic element to it to support an ecosystem that may have supported you or you're interested in learning more about. So over the lifetime of the fund, we've made 228 investments in 164 companies. That difference is what's called add-ons. A lot of times we'll invest in a company. 2 years later, they'll do another up round, and we will invest more because we want to ride the winners and invest more as we go. Our average investment, so lots of small checks relatively, these are $50,000 per investment.
And just one thing to note on that is, we have some other criteria that goes along with any investments. As we mentioned before, there needs to be a lead for the round. We're not leading rounds. We tend to, if there's not in some cases with safes, there's not necessarily a designated lead. We require that at least half of the round has been committed so far. We don't want with our small check to be one of the first checks in, and then the round doesn't materialize, or they're able to not raise the level that they wanted to, and that money's not going to be able to sustain them. And so we've over time, figured out what is kind of these right rules to put in place, so that we're making sure that we're making these investments safely. Typically, the average check's 50,000 for pre-tweeners. Oftentimes, that's been more like 25,000. And then in some cases, for some of the larger tweeners, we'll go up to 100,000, and maybe even a little bit more.
This chart just shows you kind of by year the investment numbers. 2025 was a little slower, a lot of add-ons there. So just kind of these things go through ups and downs. 2026 is off to quite a robust start. And we even track things like, if you really want to, if you're into this, we even track the mechanism, right? So there's kind of 3 ways you can invest in startups. There's a safe, a convert, and a priced round. Also, we track our tweeners and pre-tweener over time. So we like to publish this data, and we don't ever get to company level because that's kind of private and confidential. But it is helpful to kind of get a feel for the ecosystem and what's going on over time. Like you can kind of see 2022, look at that, the pre-money valuations were pretty robust back then. It was kind of the go-go years of 0 interest rates. And then they've kind of settled down around this 18, 19 million zone here. The other thing that is really great about North Carolina in investing is the wide diversity of companies. Our biggest percentage is like around 40% in health tech, or is that 40 companies? I think it's 40 companies.
40 companies, which again, I would never would have thought that would have been the case, Scott.
Yeah.
I mean,
Yeah.
And again, this has just been the triangle, so it'll be interesting over the next 2 to 3 years as we, incorporate the rest of the state as to how these numbers change. But at least for the triangle, health tech is by far and away led the way there, along with, again, consumer. I wouldn't have exactly anticipated that. Prop tech, another one, fintech, and then after that's B2B SaaS. Coming into this, I mean, I've kind of lived the B2B SaaS world. I would have thought that would have been the clear winner, and thankfully now that we're seeing a lot of the pullback on B2B SaaS, it's a good thing that maybe we don't have such a big concentration in the triangle. But as you can see, there's a wide diversification across a bunch of different sectors that I didn't even know existed until we started doing this.
Yeah, and I like the long tail too. So you'll see some things. We're in a quantum computing company that does drug discovery. We're in a robotics company that takes pig waste and turns it into sanitized fertilizer. We're in it's just an amazing. We're in a company that takes a bamboo-like plant and uses it to sequester carbon into plywood. So we're in this like really. North Carolina is interesting because there's a long tail of companies and founders building those companies. For example, the one that's doing plywood is some SpaceX engineers, and the only place they could find where they could build what they want to build is North Carolina. Because of our index strategy, we invest so much. We show up frequently in number 1 in the most active investor in the Southeast, and sometimes we will snag a headline. The one I'm most proud about is we were in the U.S. We were the most active in January of 23. We're the most active investor, and we beat out Andreessen Horowitz, so that was a big win. So we do a lot of activities. We go to a lot of meetings and spread the word. So you probably are watching this because you found us through one of those mechanisms. A couple of the frequently asked questions we get: can I invest from my 401k or IRA? And the answer is absolutely. There's a company called Alto, ALTO, that's one of the more popular ones. There's a variety of these people that have figured out how to navigate the complex rules around this. But basically, you can do a self-directed or a advisor-directed way of doing this. We have a whole blog post that goes into this, but the answer is yes. I would say about 20% of our LPs do use this mechanism, and I have as well. Why do I have to be accredited? As mentioned at the top, but this comes up a lot. It is a SEC rule. We did not create this rule to be in this type of fund we're in. You do need to be a sophisticated investor. There's a lot of noise out there about lowering those accreditation rates. I personally hope they do, but that's beyond our control. Occasionally, we do have some of our portfolio companies do crowdfunding, which could be open to anyone, and watch our social media. We do post those out there frequently. Where can I get the deal docs? When I show you on the next page how to sign up, you can actually look at the deal docs before you sign up, and I'll point you to those. Do we invest in equity, debt? So the answer is equity, yes. Debt, when we invest in a convertible note, that is considered debt, but yes, but we do not do any other form of debt where we're loaning companies money in the traditional Wells Fargo type sense. We don't do crypto, we don't do cannabis, and we don't do things that own real estate. We do invest in companies that have a real estate operating component. So they may help people buy real estate. They may help people rent or lease real estate, what's called prop tech, but we don't really get into the real estate LLCs and those types of things. In fact, we really don't invest in other LLCs because that causes a tax problem downstream for us. And then why do they want to work with the North Carolina Tweener Fund? And it's because we're easy to work with, we're fast, and also we provide, as operators, frequently we'll be the only operator fund in their cap table, and that gives them what our commitment is to the founder is we will give you a bat phone. So if you have that hairy issue, you're having an argument with your founder, I've just taken 3 calls like that this week, or you've got an inbound M&A, or you got rug pulled. There's a variety of things that Robbie and I can be a confidential source that can help you calmly walk through this and understand your options and how to navigate it as a founder would. So how do you sign up? So if you go to our website, tweenerfund.com or NC Tweener Fund, you'll find up in the upper right corner an invest button. And when you click that button, you're taken to our landing page on AngelList. And there you can click the apply now button. When you get to the AngelList apply now page, if you scroll down, you will see the documents available for download. Also, you create an AngelList login, and then you can kind of like see a little bit more information and download that document, and you don't have to sign up. So you need to go a little bit further in the process than it may seem like to get those documents, but you haven't signed up or anything like that. It's not a trick. It literally takes 15 minutes, and it's self-service, which we like. You could be watching this at 2 a.m. and decide at 3 a.m. you want to sign up, and that all works. Very low stress for you. If you want to learn more and you have any open questions, we do talk a lot about these on our site, so be sure to go there. Follow us on Twitter or LinkedIn, and you can email us directly. We're always available on email. It's Scott with 1 T and Robbie, Robbie. Thanks for taking your time out of your busy day to learn more about what we're doing here at the North Carolina Tweener Fund.